Hi everyone, let's talk about something we all know about, jobs. Finding one, keeping one, and figure out how the job market works. Yup, we are talking about unemployment and the labor market. Sound serious, right? Okay, maybe some of them is not interested with this topic, but it's super important. Let's break it down. In this video, we will focus in three perspectives. First, why the unemployment is happen. We will dive into the big picture factor that cause the number why they reach and fall. Then, how the labor market connect to the economy. Think of it as understand how the different part of the economy work together. Hold on. Last, the stage of the labor market. Is it steady and strong, or is it a house of cards, or ready to collapse at any moment? Okay, this is why the problems come in. We know about the factor are connect, but we don't fully understand how they work together to affect the unemployment. Without the clarify, we risk making the decision based on this instance of the solid evidence. Wait! By the way, we are from the group 3N from EIA2013 or C3. So grab a coffee, settle it, let's talk about the fantastic world of unemployment and labor market dynamic that happen in the United States.
Pretty interesting, right? But these variables are just the starting point. Now, let's talk about the star of the show, unemployment. Okay, so this is what we are trying to understand and predict, It is not just a number. It's about how many people are looking for a job but cannot find it. Unemployment reflects the economic health, the balance between the supply and demand for the jobs, and the opportunity available to workers. So by looking at how these variables like GDP, like interest rate, or like public debt interact with the unemployment, we can uncover the deeper dynamics of the US labor market. It's like the placing together of all the puzzles so that to become a bigger pictures. To understand how unemployment in the United States is influenced by the economic factors, we are using two tools, which is an economic models and also an econometrics models. So let's start with the economic models. Think of it like it's the big pictures of framework. It helps us to understand and hypothesize the relationship between the variables. In this case, it suggests that unemployment's UR is influenced by the five key factors, which is the GDP, debt, interest rate, the Nasdaq, and also the cost per gallon. Now, to test this relationship and add real numbers to it, we will use the economic model. This is where the math kicks in. Think of this, the model as a blueprint for solving the puzzle. Alright? So it's quantify how much each variables affect the unemployment, using statistical methods to check how well these pieces fit together to explain the change in the labor market. By combining these two models, the economic models to frame the relationships and the econometric models to measure them, we can better understand how each factor contributes to unemployment and the broader labor market dynamics in the United States.
Now that we have built our econometric model, it's an important question to ask how reliable the model is. To ensure our finding is accurate and meaningful, we conducted a series of diagnostic tests to evaluate the model's performance. Let's talk about the regression model we are analyzing. The hypothesis here is very simple. No hypothesis, none of the independent variables affect unemployment. Alternative hypothesis, at least one variable does affect unemployment. The results are clear. All the p-values are below 0.05, meaning this variable have a statistically significant impact on unemployment. They are not just random noise, they are actually influencing the results. Now, about the model's overall performance. The R-square value is 0.7611, which means the model explains 76% of the variation in unemployment. That's a great fit. The first column, the coefficients, show how much each variables affects unemployment. Think of it as the size and direction of the relationship. The negative impact is Nasdaq index, GDP, and interest rate. The positive effect is public debt and energy costs. Let's look about Nasdaq index. The coefficient here is negative 0.2198, which means that for every 1% increase in the Nasdaq index, unemployment drops by about 0.22%. A strong stock market seems to reflect confidence in the economy and job creation. The second one is the GDP. With a coefficient of negative 0.7237, GDP has the strongest negative effect on unemployment. A 1% increase in GDP leads to a 0.27% decreases in unemployment. This makes sense because economic growth fuels jobs opportunities. The third one is the public debt. The coefficient is 0.3547, meaning that as public debt rising by 1%, unemployment increases by about 0.35%. This could suggest that higher debt levels might crowd out resources that could otherwise boost employment. The fourth one is energy cost. This one has a coefficient of 0.2827, indicating that a 1% increase in energy costs rises unemployment by about 0.28%. Rising energy costs can make business operations more expensive and leading to job cuts. Lastly, let's talk about interest rate. The coefficient is negative 0.1566, which suggests that a 1% increase in interest rate reduces unemployment by about 0.16%. In the context of the US, rising rates can sometimes reflect a strong economy and confidence in stable growth. Moving on to a closer look at the discrepancy statistic for the variables in our model. First, focusing on the central tendencies, the mean for unemployment rate is 1.6604 and the median is 1.637. This indicates that the unemployment rate in the US has been relatively stable over the observed period, with no extreme outliers significantly affecting the average. Next, examining the range and variability, unemployment rate ranges from 1.188 to 2.220, representing periods of both lower and higher unemployment. The standard deviation for unemployment rate is 0.288, showing relatively low variability compared to other variables like the Nasdaq index, which has a standard deviation of 1.253, and public debt with a standard deviation of 0.977. This larger standard deviation reflect greater fluctuation in the stock market and public debt over time. When we look at the shape of the data distribution, most variables exhibit low skewness and kurtosis values, suggesting that their distribution are approximately normal. When building a regression model, it's important to ask, did we include all the right variables? Is the model capturing the data correctly? That's where the Ramsey reset test comes in. This test check if the model is well structured by looking for missing variables or wrong functional form. Think of it as a quality check to make sure the model is reliable. The test works with two hypotheses. The first one, null hypothesis, the model is correctly specified with no missing variables or structural issues. Alternative hypothesis, the model is misspecified, meaning something important might be wrong with its structure. In this case, the p-value is high, above 0.05, so we fail to reject the null hypothesis. This tells us that the model is well structured with no evidence of missing variables or functional issue. We can trust the variables and relationships included, making this model a solid foundation for analysis.
Afterward, it's important to check if the residual, the difference between the observed and the predicted value, follow a normal distribution. This is where the Barbera test comes in. It checks whether a residue is symmetrical compared to a normal distribution. The test works like this. Null hypothesis, the residual are normal distributed. While the alternative hypothesis, the residual are not normal distributed. In this case, the Barbera test is 20.57633 and the p-value is 0.000034. Since the p-value is much smaller than 0.05, we reject the null hypothesis. This means the residuals are not normal distributed. This histogram shows this to a clear skew to right and heavy tail that we did expect in a normal distribute. It's not enough to just look at the relation between the variable. We also need to check if the residual, the leftover error, behave as expected. One critical test for this is the Turbin-Watson statistic, which helps detect autocorrelation. It happens when the residual from one observation are connected to those from other correct partner that might influence the result. Since the Turbin-Watson result does not give us a clear answer, we need to dig deeper. The next step is which is more detailed and can detect highest order autocorrelation. Let's take a close look at the brush Goldfly series correlation LM test, which help check for autocorrelate in the residue. Even at the high lag, it's more detailed than the Turbin-Watson test and give a clear picture of whether the residues are independent. The test hypotheses are null hypothesis, no series correlation in the residue up to 2 lag, while the alternative hypothesis, series correlation exceeds. In our test, the F statistic is 2.575909 with a p-value of 0.0900 and the chi-square statistic is 5.5088384 and the p-value of 0.0637. Since both p-value are above 0.05, we fail to reject the null hypothesis. This means there is no strong evidence of series correlate in the residual up to 2 lakh.
Now, let's talk about the variance inflation factor, or VAF, which measures multicollinearity in regression models. Multicollinearity happens when independent variables are highly correlated, making it hard to figure out their individual effects. Here is how VAF works. A VAF close to 1 means no multicollinearity. A VAF above 5 suggests moderate multicollinearity. A VAF above 10 indicates high multicollinearity. Now, for our analysis, L and GDP, gross domestic product, and L and debt, public debt, have severe multicollinearity with VAF values over 50. L and ND, Nasdaq index, also shows high multicollinearity with a VAF above 10. On the other hand, L and CPG, post forgotten, and L and INR, interest rate, have VAF values below 5, meaning there is minimal multicollinearity for these variables. This makes sense when you think about it. GDP, debt, and the Nasdaq index tend to move together in economic trends, while variables like energy cost and interest rate are more independent. Null hypotheses, residuals have constant variance, and the alternative hypotheses, residuals have changing variance. Now let's come to the results. Variables like L and ND, Nasdaq index, and L and debt, public debt, show higher variability with standard deviations of 1.253 and 0.977 respectively. This could lead to some minor inconsistencies in the residuals variance. On the other hand, L and UR, low unemployment rate, has a much lower variability, standard deviation equal to 0.288, which aligns with the test overall conclusion. What's verdict? The test found no significant evidence of heteroscedasticity, meaning the residuals generally have constant variance. These support the reliability of the regression model. However, there might still be some minor concerns due to the outliers or fluctuations in macroeconomic variables, like GDP or unemployment during volatile period. Why does this matter? Macroeconomic factors like public debt and unemployment can sometimes show varying variance during economic changes. Well, this test gives us confidence in the model stability. Keeping an eye on outliers and considering variable transformations can make the model even more robust.
The objective of this analysis is to identify the macroeconomic factors that affect unemployment rate in the United States, and also we need to understand how they relate to the burden labor market by using a combination of economy and an econometrics model to analyze the identified key driving of unemployment, such as GDP, public debt, interest rate, the NASCAR models, and energy costs to evaluate their effect. The results show that the model explains 76% of the variation in unemployment. The R-square is equal to 0.7611, which is strong fixed. All independent variables were stratified significance, meaning they have a measurable influence on unemployment. However, diagnostic tests highlight there are areas of improvement, including address the multicollinearity and reduce the non-normality. Overall, the analysis achieved the objective, offering the values insight into the key economy driving of the unemployment. Alright, based on the analysis, we provide 4 recommendations to balance the unemployment and boost the economy. First, we focus on investing in economic growth. As 1% increase in GDP will decrease the unemployment by 0.72%. This can be achieved through infrastructure development, support small business, driving innovation in clean energy AI, which all create more job opportunity. Second, manage public debt responsibly. Since every 1% risk in debt increase unemployment by 0.35%, policymakers should prioritize productivity, investment in education, workforce training, and technology while cutting non-efficient expense to reduce debt without harming growth. Third, stabilize energy costs. As 1% risk in energy costs will lead to 0.28% increase in unemployment. Invest in the renewable energy, improve the industry energy efficiency, and utilize strategic reserve can help the business lower the cost and return the worker. Lastly, prepare the workforce for the future job by investing in reskill programs like vocational training and STEM education to match the worker with high demand industry, reduce the unemployment, and support the long-term economic growth. Bye!